Hey guys, Youthful Yields here. Today we're going to be going over the weekly portfolio review or update. So to start off, you can see that the market for the last week has been pretty red. There are really two main sectors that I can think of that are doing decent right now, and that's energy and utilities. Consumer staples is doing okay, and materials as well, but the majority of the market, I think everyone agrees, is not doing very well. This is kind of true past the week marks, like even in the 1 month. You can see here how much more that is true. You can see energy there is really the only good standing one. So yeah, good news is we were able to get quite a bit of performance this last week um, on Composer by doing some really good calculated shorts. So this last 7 day for SPY was down 2.22%. Whereas our portfolio is up 5.23%. 20% of that was from Composer, and actually we only lost 1.28% on M1 Finance, which is really cool. And we also gained 14.16 on Webull. Well, yeah, so last the last couple weeks really have been really nice. Like I guess it was the last week and I think Friday of the prior week potentially. I can't remember. We had some good short positions via SQQQ, part of our Holy Grail strategy, and that's what kind of made us catch up on this. So take a look here on how that did here. We were in quite a deep cut on this, like down 25%, and now we're up positive on that. And I also have this one here, which we are, oh, that's simulated. I'm not sure why I went that way. Up 8% on that. This was up further because we actually invested a little bit later, so it didn't go as deep, but followed the same kind of pattern. So, yeah. Oh, excuse me. Right now we are holding Teckle, which is a 3x leverage bull technology ETF. Now, the main reason this is held right now is actually because if you look at the this is the case for QQQ and SPY as well, I believe. If you look at the current RSI, it's 26, which is very low for the S&P. And because of that, we're in oversold territory, and so the algorithms are saying, okay, we predict that there's going to be quite a large jump. Now, in what case? So this happened here as well. Now, what cases we've had that in the past? I wanted to show that off. You can see here how that's done on the last thing. A lot of people are saying that this the market right now is very similar to what it was in 2022. So not really so much as this one, but it looks closer to 2022 in terms of the total setup. So you can see how that did there. But yeah. So the thing is, a lot of people are speculating whether or not this is going to hold up tomorrow. Long term, I don't care, really. I trust the algorithm. But I could see a possibility that this does not rebound tomorrow. Main reason why is Friday close. You can see the NASDAQ was still down quite a bit. This will open later today, I believe. I don't know how you do it on the... Um, I don't know how you do it on the desktop, but there's a way to do it here where you see when it opens. Maybe it's out here. Yeah, right there. So 3.5 hours, I guess we'll kind of see how that's going to really affect things on both oil and on the NASDAQ futures. So we'll see. If we see oil drop and NASDAQ go up, then that's a good sign. But I would honestly not be surprised if tomorrow oil is even higher than this and the Nasdaq is still down, which would suck for the portfolio for that day. But if that's true, the likelihood of it being even more oversold is pretty eminent. And in that case, we're still probably going to be holding Tekel if I had to guess. But yeah. Moving on into some other stuff. I guess I'll do this one first. We bulls up, I think, what did I say? About 10% this week? 14%. And so started off flip-flopping, and then the last couple of days we did pretty well. And those were the last 2 days of the week where the Nasdaq also fell quite a bit. So I think there's quite a little bit of a correlation there because the Bitcoin has actually been following that kind of trend as well. Whether or not it's actually correlated or if this is just part of its cyclical thing, I don't know. But you know. Last but not least, going on into the M1 Finance portfolio, I wanted to go over something. So I have been eyeing these because if I go in here, let me quickly go over the portfolio real quick at each level for the week. Let's do the week. So you can see energy is up. Biggest gainer there is ExxonMobil. Then we had utilities up, and the biggest one there was from Duke. And then we had consumer staples. The biggest gainer there was from PepsiCo. In terms of the opposite side of things, technology, Microsoft continues to fall, down 6.5%. Actually, Google is down almost 9%. Financials, we had even worse performance. We had MasterCard down 2.5% almost. And last but not least, healthcare. Vertex down 4.6%. So now the reason I bring up this is real quick, sorry. Let's see. I think we had one dividend, and that was this Home Depot one. So yeah. I am planning on selling some stuff, I think, for the first time since really we've been just DCAing into these. You'll notice something if I sort here, where we have ExxonMobil on the top. We skip these two. We have Chevron, skip this one, and we have Shell. Now, if you go back to some other ones, well, let me just show you the chart I made. So basically, I took a snapshot of all of the holdings on Friday that we currently have. This is just basically, the 52-week high chart, essentially. And so you can see the top six, right? ExxonMobil, Chevron, Shell, Duke, NextEra, and Southern. All of those, this is all energy, and this is all utilities. And so what I was thinking is, this is a 52-week high. What about we just sell out? Because I've been talking about moving the funds into some either ETF or something that I don't have to really manage year over year. Because although our portfolio has actually outperformed SPY quite a bit, actually, you can see it. So it's literally more than double at this point. I don't think that's going to continue. I have to be completely honest with myself. And if it can continue, I think we would have to do some plays where we, accurately identify some stuff and investigate what kind of companies are going to be doing good. And I just really don't want to be in that kind of space because it's just too speculative for me. Although we can find some really decent companies that are doing well, it's really hard to say whether or not that's actually going to come true. So the reason I'm thinking of selling these specifically is because I think this oil crisis thing could potentially fall off very soon. Let's say within the next couple weeks. And so if we sell out of these while they're really high in our portfolio, I think we're just basically locking in those gains because we're going to sell out of them anyways. So that's what my thought was. There's some other ones here that we still have very high. So you can see AMD and Google, which funny enough, those you can see Google's down here and AMD's down here. So they're only about 65% of their 52-week high, at least according to this chart. I don't know how accurate this might be, but I basically pulled the close prices from Yahoo Finance. So point is, I think I want to get rid of those 6 companies now, utilities and energy. And so I put in sell orders. Now, in the past, I've had problems with this, so I don't know how well this is going to go, because you can't remove these pies from your portfolio, and then well, what happens if you delete a pie from your portfolio, or a slice, I think they call it, yeah, a slice from your portfolio, you have to rebalance it. So let's say I have 8% and 5%. That's a collective 13%. I now have to say, okay, where do I want that extra 13% of target weight? So let's say I put it all in technology. What will then happen is it will sell these energy and utility stocks, but then it will rebalance and put all of that money into technology stocks. And I don't want to do that. The whole point of this is I can take the cash and do as I wish with it. So the way that I've heard people say to do it is you turn off auto investing and you have to go in here and actually do a manual sell order. And I think that's how M1 Finance also shows you. There's a thing, page that's like how M1 Finance works, basically how M1 Finance trades. So I heard that if you put higher than the amount that you actually have, it does do the accurate of just liquidating everything. M1 Finance also shows that if you do 95% of the target allocation, or the target amount that you have in it, it will also liquidate it. Problem that I have with that is I don't really know how it's going to look at market open. So who knows? So I'm hoping this works. If it doesn't, if these cancel, yeah, that kind of sucks. But yeah. So out of this, it's about at least the current current notional value, market value. It's about almost 5K. And now the question is, what do we go into? Now, I've been doing a lot of research over the last few days to kind of decide what I want to actually shift into. It's honestly been very tough. There's really no ETF that's actually just done better than my portfolio in terms of the risk that's put on compared to the gain that I get. I would say the closest that I would personally feel comfortable with, that I've been thinking about a lot, is going into just QQQ. If I were to do that, I'd probably do QQQM because it has slightly better, it's like slightly lower expense ratio than QQQ. The problem is, if we're going at that risk level, I feel like we can kind of squeeze out a more stuff. So I had a thought of, well, hold on a minute. Like, I love M1 Finance. It's pretty decent, but we don't use it for its full potential. Because M1 Finance, like, their whole thing is obviously this portfolio pie and slice thing. The thing is, they're also basically like a high yield savings account, from what I remember. And they also have margin loans and whatnot. Where's their this one? Yeah, it's a high yield cash account, right? Now, although that's really good, I don't really want to use that. I already have SoFi as my high yield savings account, and I'm very happy with that, at least currently. And so I was thinking, well, what really does M1 Finance offer us in terms of functionality of what we're using on their brokerage side that Composer does not? Because really, we can make exactly this thing, right? Where we say, okay, we want, 12% or 20% technology, 14% healthcare, so on and so forth. We can do that exact thing in Composer. And it's just a lot easier. To be completely frank, it's just a lot easier. So what I was thinking is just doing that. Another thing that we can do is we can actually do algorithms. So this is no algorithms, it's just pure rebalancing. Like I said, you can do that in Composer. I can show that real quick, where I can say, equal weight, or sorry, no, specified weighting, unless I have 3 stocks here. So SPY, QQQ, and um, we'll just do NVIDIA for purposes, right? And then I can say, okay, I want 50% in SPY, I want 40% in QQQ, and then I want 10% in NVIDIA. And it's that easy, right? I can choose whether or not I want to do it every day. So what that ends up happening is, let's say SPY goes below 50% and in 10, it actually goes down to, like, let's say, I don't know, 47% in one day. One of these goes higher. It will actually rebalance it. I can also say, okay, I actually don't want to do that. I want to rebalance every month instead. I can do a threshold. So you get a lot more control, whereas M1 Finance, I'm pretty sure you are actually forced to do it to where any amount of money that you get is actually just going to automatically rebalance. So that's either dividends. And the way I have it currently set up on M1 Finance is it takes the money that we get from dividends and redistributes it to the entire portfolio. They do have an option where you can take it and it reinvests in its own fund. Either way. But the way it works is, let's say I do a deposit, that's when it does the rebalance, largely speaking, because that's when I have leftover cash. So let's say I don't rebalance for 6 months. The portfolio can get really out of weight. Sometimes it's actually a good thing. There's I think a lot of studies on this, a lot of white papers that show the ideal rebalance frequency is actually, I believe, quarterly. So the thing is, for me, I invest, I add cash to the account every month. So for me, I just treat it as a monthly rebalance. Anyways, I'm getting a little bit overboard here, but point is, I don't really think I need M1 Finance at this point. And what I was thinking about doing instead is going into one of the more simple strategies that I've created. So one of them would be the one I showed off quite a while ago, and I made about last year, which is a simple QQQ lever. So if we look at just this last year, or actually let's just look at the OOS, right? So it's actually, the orange line is QQQ, the yellow line is SPY. It's actually outperformed QQQ. You can see that the cumulative return on it was 17.8%. QQQ was 16.3. It was really interesting, though. This strategy is remarkably simple. It just basically looks at overbought and oversold and uses leveraged ETFs accordingly. But it actually, to get those levels, like almost always, we're not at those levels. And so what ends up happening is we're almost in QQQ the entire time. So yeah. You can see the max drawdown is the same. So if you look at just the Sharpe ratio right here, it's higher and Sorrentino is higher, right? Sorrentino is higher. But I digress. This is the one of them that I'm interested in just because I know how it works. It's super dead simple. The other one I also made a while back. This was like in November, but I just edited up a little bit more last night. And this one's a little bit more complex, but it's the same idea, really. And so we basically check if both markets, both indexes are oversold. If only one is oversold, overbought, we only go into slightly down leverage, right? So this is 2x leverage. If both are oversold, we go into 3x leverage down, inverse. On the opposite side of things, if they're oversold, both of them, then we go into TQQQ. If only one of them is, which is QQQ, we'll go into QLD. Now, I've noticed this where QQQ tends to go to those positions a lot sooner. I think that's just because of concentration, versus like 100 versus the 500, especially in stuff like financial stocks and companies. But so let's say both of those are not true. That would mean that we're in the middle, which is pretty much the majority of the time. Now we check if we're actually above the 200-day moving average. And if we are, that's a really good sign. I'll show that real quick. Let's say here, we're above the 200-day moving average. You can see how that usually performs. It actually usually performs very well, right? Bull run above the 200-day moving average right here. And then once we cross down here, that's this other logic, right? So let's say we're not in the 200-day moving average. We short it. So we're not above the 200-day moving average, but we check if they're below the 20-day moving average. So right here we would be, for example, and right here we would be, right? And so otherwise, we just basically hold a minor, like 1.5x position. And what does this actually look like? For example, the last year, we actually did really well. You can see how that kind of shows up where the max drawdown was slightly more. And if we look at just the larger time span, and look at max drawdown here, we're actually getting less max drawdown than QQQ. Almost identical to SPY, let's say. It's like kind of between the two. Yet our performance, our annualized, CAGR is twice that, more than twice that of QQQ. So I think it's pretty nice. And if we look at like year to date as well, surprisingly, this is doing very well because it actually registered, okay, you're in the oversold territory, right? And so let's go and pump it up. And so that's what happened kind of on the Holy Grail strategy as well last week. So that's why it's up here. So while these are down 8%, 7%, this is only down 5.2%. If we take a look at like 6 months, same thing is true there. Just a little bit less on each of them. So you can see the Sharpe ratio in turn is a lot lower. So pretty cool. I'd say you can see though that the max drawdown was higher, just probably because we held like right here or right here. It just dropped faster. But I think this is the move. So I think what I'm going to do is slowly sell off the M1 Finance positions just as they reach their 52-week highs, or some of them I might actually do before that, like namely the ones that I just have a lot of profit on already, such as Google and AMD, because while I really like these companies, I'm not sure if their performance is going to keep going up, right? Especially in the market that we're seemingly shifting into. I think I'd rather take that profit of 50% on each of them, which is extremely high, and put it in somewhere else. On the opposite side of things, right? Something like Microsoft, I'm not going to sell because I think that's bound to rebound eventually. I don't know if it's going to be in the next year, 2 years. I don't know. But I think it's going to rebound eventually. I think Microsoft is really just too big to fail kind of thing. So, yeah. Some of these other companies, I also think it's just going to be eventually, like namely Visa and MasterCard. I think those are eventually going to come around. But yeah, so that's the idea, is slowly shift the portfolio into Composer. And what I'll end up doing is having this as like basically the core of the portfolio. And then, put simply, I can just say, okay, I want to add a new deposit of $3,000 into the Composer account. And so what that ends up allowing me to do is, I could then go and say, I don't know why this is so buggy. I can say, okay, I want a $3,000 deposit, and then I can simply just allocate that exactly as we already do. because again, it's functionally the exact same thing. Even if we decide to go back to this portfolio, I can recreate this in seconds in M1 or in Composer, right? Like it's just basically I can create a group of technology, put those 3 stocks in, create a group for utilities, so on and so forth. It's not that hard. And so now, to be fair, M1 Finance has done, pretty good. I think they, on in terms of tax stuff, they're a lot faster than Composer. We just finished up our taxes like last night, actually. Um, there's a few things that I need to be careful of. Obviously, going into next year, it's a little bit too late for some of these, and that's why I've changed these to no K1 because I the tax software that I use does not really support K1s, and I also just don't want to get them in the mail. It's a whole mess. Like I know you can get them online, but at least the ones that I do, from what I understand, pro shares, you have to first get them in the mail to create the account for the next year. It's just a mess. And in addition to that, I don't actually pay any fees to use M1 Finance. It's actually a completely free software for me. Because I'm above 10K. But it's just like I don't know if I need to be using it anymore. I will say the only other downside that I can truly see is if Composer were to collapse, I'll probably return to M1 Finance. I have nothing against M1 Finance. It's just that I think Composer can kind of replace it at the moment. So fingers crossed M1 or Composer doesn't collapse because then I'll be in kind of a very weird situation for the entire thing, but I doubt that. Anyways, guys, very long video. We'll see how the next week kind of performs. Like I said, I wouldn't be surprised if tomorrow is actually another down day while we are shifting into a bull run, but that will just mean that we're even more oversold. So yeah. But as always, I wish you guys a wealthy future.